So I'm putting together a course on trading earnings, and I figured this actually could be a topic for a YouTube video because I wanted to point out not only a certain way to trade earnings, but how to use a certain option strategy to make earnings very low risk. So, if you don't know already, trading earnings is essentially buying or shorting a stock before the company reports its earnings. Now, when it reports earnings, typically you're going to have a jump in the stock price, and that jump can be a jump downward or a jump upward. Here's Microsoft's earnings report, and you will see a gap in most cases. Now, if you know my stuff is usually trading after the gap, but I've focused my niche on the gap, so I'm going to do both before and after the gap because actually I've found that trading before the gap actually is quite profitable, even though it's high risk. So let's talk about this for a second. What happens if you trade before earnings? And how do you do it? And what is the best strategy? All right. So the first thing I want to show you is some profitability examples of trading on earnings. So like I said, I was putting together some graphics, so we'll just go through these. These are some of the recent ones, and I tried to use simple option strategies to show you how to do it. So let's start with some simple strategies here. Simply buying calls or puts. So here I thought that CRM, that's Salesforce, would beat on earnings. So as you can see, on May 18th, I bought a one call option, and on the next day after the earnings was reported, I sold it. So I bought it for 840 and I sold it for 1110. And of course, after commissions, I got about 50% ROI. And you'll see this with plain options contracts. All right, just plain long options. So here I bought 3 Cisco calls, and I'm playing with small amounts of money here, but you can see if you were to go in it with large amounts of money, you'd come out with a lot more because of the ROI being really high. 30% ROI there. Here's core. Again, it's just a plain long option. 50% ROI with a plain call. This one's also just a plain option on Lulu. This was, I believe, 100% ROI. Look at the dates, 2 days. So you're making all of this ROI, this 3-digit ROI profits in just a couple days, or 1 day in many times. And if you look at the earnings calendar, which you can find on NASDAQ's site, you'll find earnings every day. So you just check out the date, you look at the stock, and in a second I'll show you how to choose that stock. I don't intend for this video to be a course because I'm going to put together an entire course on it, but I'll give you the basics here. So one reason I wanted to make this video is because I was putting together these graphics, and I wanted to clarify that it's not always the best option to buy an option, pardon the pun. So some options are really great. If you're really confident that something's going to beat on earnings, like I was with ULTA, I was very confident that this stock would beat on earnings. Let me make that bigger. So I just bought the call outright. It's a very expensive stock, so the call likewise was expensive, but I was right. So my $700 investment turned out to be $1,800 for profit, well, minus the investment, right? So you only want to do calls in that case, and remember, calls are limited risk because the max you're risking is whatever you pay for it. Now, another way to do it, and one reason you're going to want to do it in this second way, is because before earnings, the price of options, whether it be a call or a put option, the price of an option tends to increase. And the way you find whether it increases is you look at the implied volatility versus the statistical or historical volatility. Now, I'm looking at AMBA right now, and I see that the green line, which is the implied volatility line, is higher than the yellow line, which is the historical volatility line. When implied volatility is higher than historical or statistical volatility, options tend to be more expensive than they really should be. So it's not a good idea just to buy the option because you're buying something that's pretty expensive. Now, if you're very confident that the stock is going to go the way you think it's going to go ahead and buy that expensive option, it's still going to pay off. But I really do recommend using a better way. And remember, if options are expensive, then it's good to sell them, right? But if you're selling them just naked, you expose yourself to really high amounts of risk. So your best option, pardon the pun again, I'll be using the word choice from now on. Your best choice here is to use a spread, because in a spread you're hedging the expensiveness of the option by selling an option and buying an option at the same time. And we did that with Amazon. So you'll see in Amazon we still got a really high ROI, got 100% ROI, but we didn't just buy a call outright. Instead, what we did was we bought one call and we sold another call. So we hedged that expensiveness, and we also hedged theta, which was the time decay associated. Now, as you know, you are this is not a credit spread, it's a debit spread, sorry. As you know, earnings trades are usually fast. You do it either the day prior, a few days prior. You can do it a month out, you can do it a couple weeks out. Sure, why not? If the options are cheap, why not? The problem is you're going to be exposed to time decay. That option's going to lose value every day you're holding on to it. So you generally want to make the earnings trades as quickly as possible. Now there are caveats to that. So we're really just hedging the expensiveness, not the theta here. But check it out. When I closed this position, I came out with $1,400, and that was on something that I spent $700 on. So I still made 100% ROI, but I didn't buy the call outright because it was just too expensive at the time. Now let's get into that caveat real quickly. Let's say I believe that AMBA is going to beat on earnings, and I think the stock is going to go up. Now, one of the reasons you might want to buy well before earnings is a lot of people are probably thinking the same way as you, and they start to buy that stock a couple weeks in advance, and you see a price increase. So here, AMBA has already increased by $5. So you've missed that gain if you believe that the stock is going to beat on earnings and the stock is going to go up. And I'm not saying it is, because I have done an earning. All right. So look, this is a stock I've analyzed for my subscribers, so I'm not going to make it public. If you want to know my thoughts on this stock or other stocks, go to damonvero.com, sign up for Copy My Trades, and you'll see my thoughts on, you'll see what I'm trading every day. So I am trading this stock. I'm not going to tell you if I'm long or short. So let's choose something else. Better example. Let's go ahead and choose, let's choose UBA, okay? And you'll probably see, because UBA is reporting, well, they've already reported, or they're about to report. All right, so we're going to look at UBA, and you're probably going to see a drift prior to earnings, a specific way upward or downward. Now, I'm not sure if they already reported, but the drift was upward. So the reason sometimes you want to open a earnings trade way before earnings, like a couple weeks before earnings, is so that you can capture that drift upward or downward. As you can see, UBA drifted from 49 all the way up to 55. So if you're playing with options with 100 delta, that's about $500 worth of profit you missed, assuming that it goes up after earnings, and maybe it already reported earnings, and that's why it's down. But that's one of the reasons you also want to hedge theta if you're going to open an earnings trade a couple weeks before earnings. So let's say we wanted to open an earnings trade on Amazon a couple weeks before earnings. In that case, this spread makes sense, because not only are you hedged on the expensiveness of the option because of the high implied volatility, but now you're also hedged on theta because both of these options are decaying in value over time, and they basically cancel each other out. All right, so that's one issue. Another issue with earnings trades is the fact that even if you have a good analysis and you're right, you could find that, here's a Microsoft earning report, all right? You could find that the stock moves in the opposite direction. So I'm going to give you an example of a trade gone wrong. I thought Microsoft would beat on earnings, and here's that drift I was talking about. It's been drifting upward, and prior to earnings it was drifting for a week or so. But what you're going to get is, maybe you're right. Maybe it does beat on earnings. Or Well, apparently this didn't. I thought it did. Alright, but typically, or maybe it did. Maybe that's wrong. Sometimes NASDAQ is wrong. But even if you're right on earnings, the problem is that after the earnings report comes out, even if you get a positive earnings surprise and you're long on the stock, the company itself could issue forward guidance that's weak. And because of that weak forward guidance, investors will ignore the earnings beat and instead they start to sell the stock. So I'm going to check out the earnings. Last time I thought it beat. Where are we? So let's see. That is April. Here you go. Yeah, okay, it missed. So I was wrong in this case, but it doesn't matter. And I'll show you why it doesn't really matter. And in my earnings course, I'm probably going to teach 2 different types of trades. I've already taught it to the subscribers and copy my trades, and I've taught it to the people who signed up for my earnings newsletter. Sorry, that's not where you go. If you go to Seeking Alpha and you go to the marketplace, which you can only see if you sign in, so I guess you need an account. But if you're going to join my newsletter, you're going to need an account anyway, right? So let's just go ahead and sign in there, and I'll show you where to get that info. So you sign in, go to Marketplace, click on Earnings. Yeah, you got to jump through a lot of hoops here. Click on Exposing Earnings, and there you have my newsletter, and I don't want to show you what's in there. But in there you see the earnings reports and how I trade earnings, and more specifically what I'm trying to tell you here is that there are certain option strategies that allow you to make earnings trades almost risk-free. So here's a earnings trade that I was wrong on, Microsoft. Now, I was wrong on Microsoft, but the trade I opened made it so that I didn't lose any money. And I'll show you the trade I made. Alright, so here we are on Microsoft. What I did was I bought 8 October 65 calls, and I sold 4 August 60 calls. And what happened is those prices canceled one another out. So after they canceled each other out, basically I have this position open for free. I paid nothing. Of course, you got to set aside some money for margin, but you don't have to pay anything. All right. So you get to open this for free, and when you open it for free, what happens is, obviously, I was looking for Microsoft to go up to 65 or above, or just move up, because what you're doing here is you're going to be long delta, which means if the stock moves up, you profit. And this is generally this is called a ratio back spread, and generally you're aiming to go over or hit this this higher of the 2 price targets. So your price target here is 65. That's what I was going for prior to earnings. So we're moving up, and around 55 I was thinking, all right, we're going to see like a really big jump in Microsoft here. That was my theory. I was wrong. Microsoft fell, and well, I spent $0, so it doesn't matter. It fell. All I have to do is just wait until these expire. So that's it. I just wait until August, and I'm okay. That's the end. So that's what happens when it goes wrong. Now, what if it goes right? How does this trade work when it goes right? Well, because I have 8 calls long versus 4 calls short, technically I'm long 4 calls. Now, those calls are at a higher strike price, so you're going to need more movement in the stock to actually capture that. But the fact is, I'm long Microsoft. So I'm long Microsoft, meaning if Microsoft moves upward, I make money. But also, if Microsoft moves downward, I lose nothing, because I opened this at $0. So technically, I'm both long and short Microsoft. Short means I don't lose anything if it goes down. Long means I make money if it goes up. And this is one of those earnings trades that's going to be really useful if you even have a little bit of doubt. So this is a type of trade I'll open when I do have some doubt on a stock, or if I think the stock is going to move really quickly in one direction or the other. With this type of earnings trade, you can make earnings trades pretty much every day with very low risk, and you can see that type of ROI, like 100% ROI, 50% ROI, almost every day. Now, obviously, you don't want to put your entire portfolio into an earnings trade, because It's highly speculative, and I have been researching earnings for about 6 months now, both the technical side of things and the fundamental side of things, to finally come up with a methodology to accurately predict earnings. And in my newsletter, you'll see, because I didn't want to show you that, in the Seeking Alpha newsletter, you'll see the archives, and you'll see that I'm accurate. I think every time I was accurate except for Microsoft, which you just saw. So you'll slowly learn my system through joining one of these services, and as I said, in the future I'll probably put out a course on earnings trading. I haven't started making it yet, but it's in the pipeline. So I think this is showing you the basics, so let me just recap real quickly. Here's what you want to do. Go check out, we don't need this anymore, go check out the earnings calendar on NASDAQ, find a stock that is liquid, it has high volume, and you could trade options on it. Alright, so you're going to want to find one with a high market cap. Now you don't have to play the same day, you can move out to the next day, you can move out to a week, but that's going to change the ideal options strategy. If you're very confident, well, okay, after you choose your stock, what you want to do is you want to look at the volatility and determine whether a option is expensive or not. If implied volatility is higher than statistical volatility, then you've got expensive options, and you're not going to just want to go long on a call or a put. Instead, you're going to want to use a ratio spread, a back spread, a debit spread. So you're going to be wanting to sell and buy options at the same time. Now, once you determine your strategy, and like I said, your best strategies are those 4 I just mentioned: long on the call or the put, debit spread, ratio spread, or back spread. Okay, so once you've figured out which option strategy you're going to use, then you just play it, and that's pretty much it. So again, choose your stock, develop your thesis. Is it going to beat on earnings? Is it going to miss earnings? Then determine whether options are expensive. Finally, choose your option strategy and make the play. So that's 4 steps in total. Again, you can check out how I'm trading earnings, and you can ask me questions in Copy My Trades. I'm very easy to get in touch with if you join this service, and the same with the Seeking Alpha Exposing Earnings newsletter. So either of those are a good way to learn directly from me on how to trade earnings, and you can use those in the meantime. I mean, you can use those while you wait for the earnings course to come out. But yeah, I didn't really have any plan for this video. I don't have a script or anything. I was just making this, and I thought I should probably make a video pointing out the differences between these different option strategies, so that people realize that when you trade earnings, you're not always going with straight puts or straight calls. They are speculative, and options are also considered to be speculative. But you can minimize your risk by being creative with your option strategies, and as you can see in the Microsoft play, you can even be wrong on earnings and not be hurt. That's it. If you like this video, please subscribe, and also leave a comment below for a video request. I'll do whatever requests you make as long as they're reasonable. So if there's anything in this video you have questions about or don't understand, it could be answered via video, let me know. Leave that request in the comments below, and I'll get back to it and make the video.